Is the US job market running out of steam? The US job market is showing signs of fatigue, and it's a wake-up call we can't ignore. But here's where it gets controversial. While some sectors are thriving, others are barely clinging to survival, leaving many workers in a precarious position. The latest data suggests that the engine driving employment growth might be sputtering, raising concerns about the economy's overall health. The July jobs report, set to be released at 8:30 a.m. ET on Friday, is anticipated to reveal a net gain of 115,000 jobs, a notable slowdown compared to June's 147,000. The unemployment rate is expected to edge up to 4.2% from 4.1%, according to FactSet consensus estimates. While these numbers aren't catastrophic, they signal a shift that warrants attention. From January to June, the US added between 102,000 and 158,000 jobs monthly. According to the Bureau of Labor Statistics, these figures are solid and generally align with the break-even point, where job creation keeps pace with labor force growth. However, and this is the part most people miss, outside of the 2020 pandemic recession, this 130,000 jobs per month pace is the weakest January to June average since 2010, when the US was still recovering from the Great Recession. Heather Long, chief economist for Navy Federal Credit Union, highlights a troubling trend. We're becoming increasingly reliant on a very narrow slice of the economy to drive job growth. Right now, there just aren't enough jobs, regardless of factors like AI or tariffs. Her statement underscores the fragility of the current labor market. Hiring has become sluggish, with only a handful of industries showing resilience. Businesses are hesitant to expand their workforce, largely due to uncertainty surrounding President Donald Trump's volatile trade war and the unpredictable trajectory of tariffs. Elizabeth Renter, senior economist at NerdWallet, explains, when companies can't forecast economic conditions, they tend to pause hiring until the picture becomes clearer. In today's environment, that clarity is constantly shifting, leaving us in a perpetual holding pattern. Compounding this issue is the reluctance of workers to switch jobs, discouraged by limited opportunities. This has resulted in a labor market with minimal turnover, far from the dynamic churn needed for a robust economy. The Job Openings and Labor Turnover Survey released earlier this week confirmed this trend, showing fewer job openings, hiring at a one-year low, and a quits rate below the 5-year average. While layoff activity hasn't surged recently, job cut announcements have trended higher this year, largely due to the Trump administration's cuts to federal agencies. Initial jobless claims remain low, but continuing unemployment claims have consistently hovered near a November 2021 high. New Labor Department data revealed that first-time unemployment claims ticked up to 218,000 last week, with continuing claims holding steady at 1.946 million. Looking ahead, Challenger Gray Christmas's job cut tracker reported 62,075 layoffs announced in July, a 29% increase from June. Andrew Challenger, senior vice president of the firm, notes federal budget cuts are impacting nonprofits, healthcare, and government sectors. AI was cited for over 10,000 cuts last month, and tariff concerns have affected nearly 6,000 jobs this year. The unemployment rate dipped in June, but so did labor force participation, raising questions about the true health of the job market. The unemployment rate, once a reliable economic indicator, is now complicated by factors like immigration shifts. Foreign-born workers, regardless of legal status, have accounted for about 3/4 of labor force growth since February 2020, according to Wells Fargo economists. Recent efforts to curb unauthorized immigration are contributing to a shrinking labor pool. Job growth is heavily concentrated in a few sectors, particularly healthcare, social assistance, and education. In June, these industries, representing less than 15% of overall employment, accounted for 94% of job gains. However, economists caution that some anomalies may have inflated state and local government job gains, which were reported at plus 80,000. The diffusion index of private industries, which measures the breadth of hiring, stood at 49.6 in June. A reading below 50 indicates that more industries lost jobs than gained them, highlighting the uneven nature of the recovery. Tariff-related uncertainty remains the primary drag on the labor market, followed by post-pandemic workforce rebalancing and, to a lesser extent, the impact of AI. While wages continue to outpace inflation, the economy is showing signs of a K-shaped recovery, where the affluent drive growth, while many others struggle. People are stretched thin, Long observes. If the labor market remains weak, it could exacerbate issues like growing household debt. The question now is whether tariff clarity by summer's end and a potential rate cut by September can reignite hiring. Here's the controversial question. Is the current job market stagnation a temporary hiccup or a sign of deeper structural issues? Share your thoughts in the comments. Let's spark a discussion. July jobs report forecast. Slower hiring, rising unemployment rate. The job market's recent performance is stirring up quite a bit of discussion, and for good reason. Many are wondering whether we're witnessing a slowdown that could hint at more lasting economic cooling, or if this is simply a temporary pause amid a still robust system. But here's where things get interesting. The upcoming July employment report is expected to reveal further signs that the labor market is losing some of its previous vigor, with hiring growth tempering and the unemployment rate edging up slightly. Let's unpack what analysts are predicting and what it might mean for the wider economy. According to consensus estimates from FactSet, non-farm payroll jobs are projected to have increased by around 117,500 in July, a notable slowdown from June's 147,000 boost. Meanwhile, the unemployment figure is expected to inch upward to approximately 4.2%, up from the previous 4.1%. These numbers suggest a cooling trend, or as some economists say, a softening in the labor landscape. Kathy Bostjancic, the chief economist at Nationwide, observes that this downturn in growth hints at broader economic weaknesses, particularly in sectors that are sensitive to economic shifts, often called the private cyclical sectors. She points out that the private industry remains somewhat sluggish, leading to limited income gains across the board. She also highlights that despite tariffs not having hit as hard as initially feared, their impact is complex. Instead of causing widespread layoffs, many companies are adopting a cautious stance, waiting and watching before committing to new hiring. Here's a quick snapshot of what the July report is expected to show. The release is scheduled for Thursday, August 1st at 8:30 a.m. Eastern Time. Jobs are expected to grow by 117,500, down from June's growth rate. The unemployment rate might rise slightly to 4.2%. Wages could see a modest rise of about 0.3%, slightly higher than June's 0.2%. Despite moderate growth, there's concern about employment in industries that are highly sensitive to economic changes. Bostjancic emphasizes that no net new jobs have been added in these sectors, which is a sign of caution among employers. She also notes that although wages are rising, the increase in work hours has been sluggish, leading to stagnating income gains overall. This pattern mirrors broader economic conditions, where job creation is still ongoing, but not as vigorous, and income growth remains restrained. Interestingly, some financial institutions like Goldman Sachs and UBS are more optimistic, hinting at a possible bounce back or at least a slower, steadier pace of job creation, though still modest by historical standards. Goldman Sachs forecasts a somewhat firmer but still subdued pace of around 100,000 new jobs, while UBS expects a sluggish increase of approximately 95,000, with the unemployment rate nudging back up to 4.2%. They attribute much of this slowdown to the recent deceleration in government hiring figures, which had seen a surprising jump in June. As for the unemployment rate, Bostjancic believes it could rise slightly. Her initial estimate is a modest 1/10 increase, but she also points out that the previous month's decline may have been partly due to fewer people participating in the labor force. That is, some workers giving up on job searching or temporarily stepping away. When adjusting for this, she suggests the real unemployment rate could be closer to 4.7%. The big question remains, are these signs of a temporary slowdown or the beginning of a more substantial shift? The upcoming report will surely fuel ongoing debates about the true health of the economy and whether policymakers need to act sooner rather than later. Do you see these trends as a gentle lull, or is this just the beginning of a more pronounced economic shift? Feel free to share your thoughts or predictions in the comments. This discussion is far from over.